Hello ladies and gentlemen, and welcome to another video. And guys, in today's video I'll be showing you and teaching you a trading strategy that has a high win rate and it only needs to operate on one time frame with no daily bias. Okay guys, so again I'm going to be explaining everything in this video, so make sure you watch it to the very end. But guys, before we get into it, don't forget to hit the subscribe button down below and hit the like button for some more awesome content. Okay guys, so guys, let's jump straight into it. And as you guys can see, I've brought up the chart of Nasdaq E-mini futures over here, and below it I have brought the chart of the S&P 500. Okay, so guys, in this trading strategy we're going to understand that number one, it only requires one time frame, and the time frame that I've chosen for this strategy that has a very nice high win rate and it's very clean is the 5-minute time frame. Okay, so again we're going to be operating on the 5-minute time frame, so it's quick enough for us to see opportunities that lie ahead, but again it's not slow enough so that we only have one trade every 2 months, for example. Okay guys, so guys, number one in the trade plan is to understand SMT divergence. Now SMT stands for smart money technique, but ultimately we're saying we're looking at divergence, and divergence is when we're looking at correlated pairs. So in this scenario you guys can clearly see that if I just stretch this up a bit, you guys can clearly see how Nasdaq is moving. See, Nasdaq up here is moving very similarly to the S&P 500. They are correlated pairs. Okay guys, now the divergence occurs when one does something that the other did not do. So say for example, this is talking relative to highs and lows, so you guys can clearly see guys what's happened here. We've got a high here, and then after that we've got another high here. This is a higher high. We can see that price has made a higher high in Nasdaq, but in the S&P you guys can see we've got a high here and we've got a lower high here. Price did not make a higher high, so now we have divergence. Okay, so guys, I'm going to draw that out for you. So again, we've made a high here, but here we made a lower high. Price did not go up any more further. And what does that tell us? Again, like I said, it's diverging because they're not moving so correlated at that moment in time. You guys can see high, and then here we made a high here but a lower high on the S&P. Okay, so that's tick number one. We now have SMT divergence on the M5. Okay, now the second most crucial part of this trade plan is MSS, also known as a market structure shift. Now how can we tell when we've got a market structure shift? Well, the answer lies in the change of the fractal nature of the market. So you guys can see we've got a low to a high to a low to a high to a low to a high to a low to a high. You guys can clearly see that. Now if price breaks this low here, then now we have changed direction. We are now offering sell side liquidity. And guys, if I just move this arrow out the way, I want to draw the low, and you guys can clearly see the low is over here on this candle, and it was broken with this bearish candle here. So now we have, or now we're going to be offering sell side, and you guys can see we have a likelihood that price is now going to come in the opposing direction. But this is the key thing. Every single thing on this trade plan is extremely important. Okay, once we have divergence, guys, you're going to notice that there's divergence practically everywhere and anywhere. But it's important to understand that we have every other criteria in this trade plan to make sure that it gives us the high win rate we're looking for. Okay, so guys, as you saw, we now have broken market structure here. We have a market structure shift. So now that ticks off number two in our trade plan. We have a shift in market structure. Now, number three is FVG, or also known as a fair value gap. We need to have a fair value gap when the market structure has shifted. What do I mean by FVG or fair value gap? Well, what I mean is on the wave or the movement that caused the break in market structure. So you guys can see that we had this down move here. So I'll draw that with a nice arrow over here. So high to low. On that down move that broke the market structure, we must have a gap between any candle 1 to candle 3. So, for example, we can see that there is a gap between candle 1, candle 2, candle 3. We have candle 1 over here, and we have candle 3 over here. Now we look at the low of candle 1 and the high of candle 3, and you guys can clearly see the low of candle 1 is here, the high of candle 3 is here, and you guys can clearly see there's a gap. So I will draw this gap out for you guys over here, just like that. And that is what we call FVG, or fair value gap. Okay guys, now again, like I said, if it's in a bullish scenario where you have for example, 3 candles like this, 1, 2, 3, then again, the fair value gap is the difference between the highest of the candle 1 and lowest of candle 3, and that is the fair value gap. So again, we anticipate price to come down before it comes up. But again, that's in a bullish scenario. In this, we now looking to go short because price has broken market structure over here, and we have a fair value gap. We have a gap in price on the M5. So now we have number 3 ticked. Okay, so now what does this mean? This means that we can now look to enter. Okay, we can look to enter a trade and target the next high or low. Okay, so say for example, we have this fair value gap here. What we're going to do is, in fact, I will go back just a little bit to make this a little bit clearer. What we're going to do is we're going to place an order at the fair value gap. Now you can place it at the low or the high of the fair value gap. Again, to make sure that you're in this, I'll put it at the low because we're looking to go short, and we would cover the high. We'll make sure we cover the high. That's important, okay? Because now we anticipate price to be going down like this. We don't anticipate price to break the high, so we'll have a stop loss that covers the high, okay? So that's important. Now, the last thing is targeting the high or the low of the swing. Now, this is very, very important, okay, guys? You guys can see that on the macro perspective, we've got a low, high, low, high, and now we've changed within here, within the fractal nature of this swing. You guys can see high, low, high. We can see we've changed in the state because we've broken this market structure. Again, we've got a market structural shift. So we are now targeting the last low, which will be over here. And I will actually draw this out. This would be the low right there. That's the low we're targeting. Okay, guys. Now, why are we going to be targeting this? Well, the reason being is because number one, like I said, we have got this fractal nature of the market, low to high to low to high. Now we've got a change in state in the internal fractal nature of the market. So expect at least this low to go, because again, price could still be on the bullish swing. It could just sweep this low down here and then continue going up. So we want to make sure that we're profiting at the most closest profit target, which is that low. Okay, guys. So again, we'll stretch this out. So we're looking at an approximate 2.63 as the risk to reward. So guys, as you can see, let's play the next bars and see what happens. You guys can see we're tagged into the trade and price plummets down very nicely, ranges around for a bit, and then we continue to hit our target. And then we have hit the target for 2.63R. Okay, guys. So guys, I hope that made sense. Remember, guys, the most important thing of this very simple strategy, like I said, it only needs one time frame, which is the M5. It doesn't require any daily bias. But like I said, all aspects of this trade plan are very important. Divergence occurs everywhere, but we need divergence with a market structure shift and a fair value gap. Remember that the fair value gap has occurred because, again, price moved so quickly, it wasn't able to offer price in that area. So we understand that price is going to tend back up towards it, reoffer it before filling in some orders and shooting down again. And that's exactly what happened here. So guys, very simple plan, very powerful, a very high strike rate. I highly recommend you guys go ahead and backtest this with correlated, very, very correlated pairs and prove to yourself it works. And again, it's a fantastic strategy that doesn't require daily bias and it only requires one time frame. So like I said, guys, I hope you enjoyed this video. Please feel free to check out my links down in the description below. But for now, have a great trading week ahead. Take care and peace.